you've got a recession looming. We've got all these dire warnings from policymakers, from other CEOs. What are you preparing for?
We've been preparing for a war since March of 2020.
SoFi CEO Anthony Noto recently announced on their latest earnings call that SoFi beat expectations and had their highest earning quarter ever, while at the same time competitors like Robinhood are announcing job cuts. And even large finance companies like JPMorgan Chase are seeing their stock prices collapse amid earnings misses in the face of a potential global economic recession. So how is SoFi making more money than ever while every other finance company is getting crushed by the falling economy? And what does that mean for SoFi's stock price, which after a rough start to the year is up nearly 50% since the start of July? Well, welcome to FinTech, and in this video I'll be going over the unique way SoFi runs its business that is absolutely crushing its competition, running a lending business, a financial services app, and a tech platform all in one. I'll then look at SoFi's latest earnings numbers that show how SoFi is currently performing, and stick around until the end of the video to see my prediction of how SoFi will use their secret weapon to continue to grow the company's earnings and eventually their stock price. And if you appreciate me reading SoFi's earnings presentation and their entire earnings call transcript, which was not short by the way, and condensing all this into a simple video, please just hit the like button and let's get into it. So to start out, we need to understand how SoFi's business works at a high level, because it's very different from other investing apps like, say, Robinhood. SoFi is really three businesses in one. There's lending, which includes SoFi student loans and personal loan businesses. There's financial services, which includes basically everything in the SoFi app, so SoFi Invest, SoFi Money, the SoFi credit cards, things like that. And then lastly, you have the SoFi Technology Platform, which is made up of tech companies that SoFi has acquired, including Galileo and Technisys, each of which were billion-dollar bets from SoFi in their quest to build the AWS of fintechs. Now, at first, you might think that running three businesses in one might be disorganized or split SoFi's attention, but in reality, SoFi has been very specific in the businesses that they are pursuing, and they all tie into SoFi's financial services productivity loop. This is a strategy where SoFi uses its very customer-facing products like SoFi Invest or SoFi Money to capture new customers and then funnel them down into more valuable products like lending. This allows them to make way more money per customer, and this gives them a huge advantage over other fintech companies because they can spend way more money advertising while still making a profit. Which is why last year SoFi spent under $100 million in advertising and managed to increase its revenue 4 times in a single year. And we'll get into some of the numbers that show how this strategy is more than just talk and will allow SoFi to potentially double or even triple in size without even needing to launch new products. So to really break down how the financial services productivity loop works, imagine you're a new SoFi customer. You first heard about the company from one of their recent big marketing stunts, maybe from seeing SoFi Stadium in a YouTube video or by coming across the SoFi Money Moves campaign on TikTok, which saw more than 8 billion views and more than 1 million uses of their branded hashtag. You decide to download SoFi Invest to start trading stocks, and while you're using it, SoFi feeds you an ad to check out SoFi Money and open a bank account with them. So you decide to open a savings account, and they offer you a crazy 2% interest rate on your money when you set up direct deposit, which is higher than pretty much any other savings account out there today. And SoFi can afford to do this because they own their own bank after acquiring Golden Pacific Bank earlier this year, giving them access to much cheaper banking services than their competition has. Like Robinhood, who has to offer their banking services by partnering with an existing bank, or even tech giant Apple, who can only offer their credit card in partnership with Goldman Sachs. SoFi doesn't have to deal with any of that. They are their own banking partner. But now that you have direct deposit set up with SoFi, they start to identify areas of your spending that could be improved using their SoFi Relay service, or they could suggest options to refinance your student loans at a lower rate. Over time, you start to use more and more of SoFi's products, and you're happy to do it since they only make you offers that they know are helpful to you. It's almost like you're entering the SoFi ecosystem, where everything just works perfectly together and a single company can meet all your financial needs. It almost sounds like another company that I know has their own very sticky ecosystem of products. Now, all that sounds great in theory, but as investors, we only care about a story if there are numbers to back it up. And if SoFi's financial services productivity loop is really such a secret weapon, do the numbers tell the same story? Well, as you're about to see, they absolutely do. See, SoFi makes the majority of their revenue from their lending segment, and they always have for as long as they've existed as a company. But if SoFi takes an existing SoFi app user and then upsells them to become a lending customer, they are on average twice as valuable as a customer that they acquire for the lending platform directly, according to SoFi's CEO. And this is just one example of the power of SoFi's integrated ecosystem on the business. So let's take a look at SoFi's latest earnings report to understand why SoFi's stock price increased by 50% in a single month, and if this strategy is going to continue to perform for SoFi, or if we're reaching the end of the runway. The single biggest reason SoFi's stock price has shot up is SoFi beating expectations in their most recent earnings call for Q2 2022. They saw their total revenue increase to $356 million this quarter, up 50% from where it was a year ago, while at the same time increasing their EBITDA, which you can basically think of like profit, to $20 million for the quarter, up 81% year over year. This beat in earnings led SoFi's stock price to jump 30% basically overnight, and that's especially impressive during a time when other companies are seeing their overall earnings drop. SoFi's total members hit 4.3 million this quarter, up a nice 69% year over year, and making for their second highest quarterly increase in members ever. This growth again bucks the market trend, with big banks claiming that retail investors are losing interest in investing and leaving their platforms. SoFi also had their second highest ad of new products being used, up 702,000 in the last 3 months to 6.6 million products overall. That's an increase of 79% year over year products being sold. Now this number is higher than overall members because one member might use SoFi Invest as one product and then also hold the SoFi credit card, which would count as 2 separate products. So the fact that the number of products is actually growing even faster than the total number of members really shows that the financial services productivity loop is in fact working. In fact, based on these numbers, SoFi would be growing even if they didn't acquire a single new member simply by cross-selling to their existing members. But as impressive as these overall numbers sound, the real meat of the data, the numbers that will tell us how the business is actually performing and where it's likely to go next, is best seen by looking at SoFi's 3 individual business segments. So in this chart, we have SoFi's business of lending, financial services, and technology platform, and we'll leave either a thumbs up or a thumbs down for how they are currently performing. Then we'll go through and see how likely they are to perform well going forward based on SoFi's current strategy. So starting with lending, which is SoFi's bread and butter and was actually SoFi's first offering back when they only offered student loans out of Stanford Business School. SoFi's lending segment took a huge hit when the president put a moratorium on student loan payments, meaning demand for private student loans pretty much dried up overnight. Luckily, SoFi CEO Anthony Noto was quickly able to pivot away from student loans and into personal loans to fill the gap, and that business has been absolutely booming. SoFi's lending business saw revenues of $250 million this quarter and a contribution profit of $142 million. That puts their revenue up 45% year over year in this segment, so pretty decent growth, but their margin is up to 57% this quarter, up from 52% a year ago. So SoFi's lending business isn't growing as fast as their smaller segments like the financial services or technology platform, partly because they're just growing off a much larger base, so it's harder to grow as much, but also because they are focused on improving profitability in this segment and making it the cash cow of the entire business. It's pretty impressive that SoFi was able to switch from a mostly student loan lending business and move into personal loans so quickly and profitably while still offering high quality loans. In fact, SoFi's average borrower makes $160,000 per year and has a FICO score of 748, which shows that these are really well qualified borrowers who are unlikely to default on their loans. So I'm going to give the lending segment a thumbs up for current performance. Plus, at the same time, this segment has started to accelerate its growth as the financial services productivity loop has really kicked in, and more members are being cross-sold from other SoFi products. Plus, remember, all this has been happening during the student loan moratorium, meaning SoFi has been operating at around 25% of their previous student loan volume since 2020. And when that moratorium expires, that is going to result in a massive boost to SoFi's lending business. SoFi is currently predicting the pause on student loan payments will end at the start of 2023. So I think that is enough to tip this segment's future potential into the positive and give it a thumbs up. Next up, we have SoFi's financial services segment, which includes the SoFi app and acts like a top of sales funnel for the rest of the company. The big news here is SoFi's banking services, which now that they have their own bank charter, they are managing to make more money than ever while offering their customers better deals than ever before. This is why SoFi Money members have increased 92% this year to 1.8 million accounts with a higher average bank balance at the same time. On their latest earnings call, CEO Anthony Noto pointed out that it took SoFi 3 years to get its first $1 billion in bank deposits. But after acquiring their bank charter, SoFi grew that number by an additional $1.6 billion in just 3 months. months. And on the SoFi Invest side, SoFi is actually seeing growth in members while pretty much every other investing app is losing users. So SoFi decided to ask new customers why they were signing up. And well, half of people said they wanted to catch up on investing, and the other 50% said they saw it as an opportunity to buy in at lower valuations. These sound to me like long-term investors who will stick around for a while, not people who are looking to make a quick buck. Add on to this that SoFi doubled their total financial services products year over year. Giving this segment a thumbs up for current performance is a no-brainer in my opinion. Now, the segment has seen some deceleration in overall growth, going from growing over 200% per year back in Q2 2021 to 179%, then 155%, then 111%, and now 100% in the most recent quarter. That slowdown in growth does tend to happen as numbers get larger, but we will want to see that growth rate eventually stabilize and stop dropping. Now, I personally think SoFi is relying on its technology platform to make up for this slowing growth in financial services products, and so for now, I'm going to give this segment a neutral thumb sideways for future potential, and maybe a little bit more on the negative side than the positive. The last and arguably most important segment is technology platform, the center of SoFi's goal to become the AWS of fintechs. So what does that mean exactly? Well, AWS is Amazon Web Services, and it provides the technological cloud backbone of most technology services that you use today. Amazon obviously uses it for their own products, but Netflix also runs on AWS, GE uses AWS, heck, a good portion of the government runs on AWS. SoFi thinks if they can build the technology infrastructure needed for moving money around, processing transactions, setting up credit cards, other companies can then run their businesses on top of SoFi's technology, the same way that businesses run on top of AWS. This is a massive bet on the part of SoFi, but if it works out, it will fundamentally change the way banking is done in the US and maybe even the world. Now, it's hard to say this early on if this will be successful, but we know SoFi has invested aggressively in this area by acquiring Galileo for $1.2 billion and splashing out for Technisys shortly afterward. So I'm going to go out on a limb here and give technology platform a thumbs up for future potential. But how are they performing today? Well, the majority of SoFi's technology platform is made up of the Galileo acquisition. Galileo now has 117 million accounts registered, up 48% year over year. This growth rate is starting to decelerate down from over 100% growth a year ago, but that's kind of understandable when you're seeing numbers like 117 million users. Galileo may actually be getting close to saturating its market for payments processing, which means SoFi's next step of integrating the Technisys acquisition and then launching their B2B business is more important than ever. Now, I very strongly think that this is a smart strategy for SoFi as it diversifies them away from only making money from consumers, and they'll get a lot more stable earnings from other companies using their platform. So it positions them really well for the future. That being said, until we start to see the B2B business take off, I'm going to give this segment a very light thumbs down for current performance, because if everything were to just continue on its current trajectory, this business would stop growing within a few years. So okay, we have this chart of SoFi's business segments. What can we learn from it? Well, the chart seems to show that SoFi's future potential looks great, while its current performance is a little more mixed. And I think that this is okay for a growing company, but this could also explain why SoFi's stock price is not reflecting its future growth and is instead focused on only the business's most recent few quarters. That makes sense during economic uncertainty that the market isn't willing to pay for future growth, and it helps explain why SoftBank is selling at least part of its SoFi position as it consolidates its holdings. Now, personally, I care more about how SoFi looks 5 years from now than how it looks during this period of economic uncertainty, so I'm a little bit more willing to bet on future growth than I guess a company like SoftBank is. But even in the short term, I do think that there is potential upside here. If we look at SoFi's expected earnings for the year, they are estimating that they will make between $830 and $835 million, up 50% year over year, which would basically match their performance for the quarter, so it's nothing too exciting. But personally, I think this may be a lowball. On the earnings call, Noto kept emphasizing how they were being conservative based on uncertainty in the macroeconomic environment, but that they were, quote, still very optimistic in the forward outlook. To me, this seemed to indicate that they were sandbagging estimates just a little bit in case things took a downturn, but barring any kind of downturn, they would beat and raise these estimates next quarter, which could result in a jump in the stock price, or it could already be priced into the very nice 30% rise that we saw over the past month. But that then brings us back to the question at the start of the video. How is SoFi winning while other fintech companies are struggling amid a probable recession, and what would let them keep winning going forward? Well, Well, SoFi has a unique ability to pivot and do it very quickly. In 2020, when student loan payments were paused, SoFi immediately pivoted to offering personal loans instead, and did it so quickly that it didn't even impact their IPO. When other companies were focused on growing their user base at all costs, SoFi instead focused on acquiring back-end companies like Galileo, Technisys, and Golden Pacific Bank. Not to make a big splash in the market, but to set themselves up for the future. SoFi's financial services productivity loop lets SoFi diversify into multiple complementary businesses. So if one business goes down, they can just shift focus toward a different one to make up for it. And then by actually offering good products that people want, they can grow their user base just by cross-selling within their ecosystem without even needing to grab new customers. So as long as SoFi keeps one eye on the future like they've done so far, and they continue to focus on releasing products that are valuable to their members, I think SoFi can go beyond just being the AWS of fintech. I think their ecosystem could become almost like the Apple of all of finance. Now, I do currently own shares in SoFi, and I roughly tripled the size of my position in the stock after they reported their latest earnings, though it is still a smaller position in my portfolio. And I'll have a referral link if you want to sign up for SoFi in the description. Don't forget to like and subscribe, and I'll see you next time.